Here's another check on Disney. Shares are down about 4.5% in the after hours on the back of earnings. The company's call just wrapped up. Let's get straight to Julia Boorstin live with Disney CEO Bob Chapek. Julia.
Melissa, thanks so much. And that's right. I'm joined now by Disney CEO Bob Chapek. Bob, thank you so much for being here straight on the heels of your earnings call. And we're very happy to be back in person.
Nice to be here.
So, Bob, a lot of focus on those Disney Plus subscriber numbers. The 2.1 million added was in line with what you said would be low single-digit millions, but much smaller than the 9 million that analysts had been anticipating. And this does raise some concerns about how you are going to get to those long-term goals. What do you anticipate being the drivers over the long term? How are you going to hit those numbers?
Right. We reaffirmed our guidance of 230 to 260 million households, and we believe that there are two primary drivers of that growth. First one is going to be the expansion into new markets. We're going to double the number of markets that Disney Plus is in international territories by fiscal year 2023. And the second component is obviously going to be new, fresh content across all of our wonderful Disney franchises.
Yeah, a lot of focus on that investment in content. And a question as you think about investing more in local language content, because that was a big piece of news on the call there. Does that mean that you anticipate being able to raise prices internationally? The international subscribers traditionally have lower average revenue per user than the domestic ones.
We have 340 new originals planned for our international markets over the next couple of years. So we are making a substantial investment in local content. We do believe that we offer a tremendous price value to consumers around the globe. And all of our research indicates that. And as such, we think we've got some headroom, if you will, in terms of pricing in the future.
Headroom in terms of pricing, but you just had this really big discount that you were offering for Disney Plus. What does that tell us about how Disney Plus subs are doing so far in this quarter and what you anticipate doing in terms of internationally raising prices as well?
That promotion was planned a long, long time ago because it's a trial promotion. You know, after being in the market for 2 years, if people haven't tried Disney Plus, we want to give them a little incentive. It's only for 30 days, and we believe that a large number of those subscribers will stay on with the service once they see how fantastic it is. And we believe that because our churn rates are extraordinarily low. So that makes it a pretty good proposition to come in and, you know, have a trial type offer like that.
Now, one area of strength in those streaming numbers was ESPN Plus. Better subscriber growth than anticipated and also higher revenue per user. You reiterated your commitment to sports in general. What does that mean in terms of what kinds of sports rights you might go buy? The NFL Sunday Ticket, those rights are out there. Does this mean you're determined to get them?
Well, we are in discussions and negotiations with the NFL for those rights. We think they would make a particularly good addendum, if you will, to our ESPN Plus service, given the nature of what they are. But we're very bullish on sports. We mentioned during the earnings call the idea of gambling as a new revenue stream, a newfound revenue stream for us, which we think is spectacular. But as you know, with every one of the new rights deals that we cast over the last year and a half, every one of them has a very significant component for the DTC sports world. And so we're very bullish on ESPN Plus growth in the future.
Does that mean you have any more insight into when you might separate out ESPN Plus in terms of totally taking some of those rights that are on TV and shifting them over to streaming?
We're going to let the consumer be our guide there. The more and more the consumers try ESPN Plus and enjoy it and subscribe to it, gives us the wind in our sails, if you will, to believe that that's really where the consumer is going to go. And so we're gradually making those types of changes where we take a bit more every month, every quarter into ESPN Plus, and so far it's been a very successful experiment.
Speaking more broadly about the competitive landscape, you have Amazon buying sports rights, you have Apple potentially in the running for those NFL Sunday Ticket rights, and then you have Netflix, which has just been investing so much in content, forecasting a very strong fourth quarter. How do you see your services playing into this increasingly competitive landscape? And do you think that's one reason you didn't see the growth that some of the analysts had hoped for this past quarter?
Well, I don't think it's just about distribution. I think it's about the brand. If I were a league, I would want my sports rights to sit with ESPN because of what we can do. The Monday Night Football with Eli and Peyton, tremendous innovation. It's brought tremendous energy. It's in the cultural zeitgeist. And I think if we can do that as the Walt Disney Company, as ESPN, for a sport, then that's basically where I think the rights should go.
But in terms of the streaming services in general, do you see your growth as coming up against the growth of Netflix and their investment in content? Is this market starting to get too saturated just for streaming services in general?
Well, I've said before that I believe that there will be a couple players at the end of the day that will both be able to do well and be very robust direct-to-consumer services. I certainly think Disney's going to be one of them. When you have the combination of our brands, our franchises, great storytellers across each one of those franchises, plus our commitment to this marketplace, I think we'll be there in the end.
Talk to us about the theme parks. Greater operating loss than anticipated. What are you seeing right now, particularly for bookings for next year?
We're seeing really great demand. Very thrilled with our demand, not only internationally, but especially domestically, but particularly, again, because of our guest experience improvements at numbers per caps, if you will, that are very, very strong and very, very healthy. So not only do a lot of people want to come, but when they come, they want to really engage in Disney.
On the call, you mentioned the metaverse. Will we all eventually be paying Disney parks prices to go into the metaverse? What is your vision for Disney in the metaverse?
Well, my vision is to use Disney Plus as the platform for the metaverse. I think it really blends our physical beings with our digital beings and creates a three-dimensional canvas, if you will, for our creative storytellers to paint so that we can create experiences that otherwise have been defined as it's a park experience or it's a movie experience or it's a book experience. I think those all come together without boundaries, without borders, without constraints. And our creatives are just biting at the bit to get into the Disney metaverse.
And just so I'm clear, would this be something where you're wearing a headset, VR goggles?
Yes and no. It could be that, but I don't think that every one of those experiences is going to necessarily have to have a headset on. That is not our plan.
So from the virtual world to the very physical world, tell us about what very tangible things in the real world, the constraints you're feeling from supply chain issues and also inflation. How are both of those factors impacting your business?
Well, we talked a little bit in the earnings call, a little bit about what's happening to the ad market because of some constraints and like automobiles and things that are electronics have chips in it. We're seeing some of that. We are seeing a little bit of supply constraint in our consumer products businesses. You know, we're in 163 different categories with our consumer products business all over the world. So we definitely are feeling a little bit of a pinch there. But our underlying demand for consumer products is very, very strong because of the strength of our franchises.
And just a final question about your theatrical movie business. You just had a big release with Eternals. You have some more movies coming out which are going to have an exclusive window. But you said on the call that you want to have flexibility. Going forward, how much can we expect your movies to have simultaneous releases, a shorter than typical window, or what is it going to look like?
I think the consumer's going to drive us there, just like they have throughout the entire pandemic. And I think flexibility is going to be in order. And we take the reads from all the different stimulus that we get in the marketplace and make our decisions individual title by individual title. So I think it would be a mistake to look at any one particular point in time and extrapolate at that and say, well, that's Disney's strategy. Disney's strategy is going to follow the consumer, and we're going to make it on the fly as necessary as conditions change.
Well, the theatrical business certainly looks very different on the other side of this pandemic. Bob Chapek, thank you so much for talking to us on the heels of your earnings. We really appreciate it and very grateful to be back in person. Melissa, back over to you.
Thank you very much, Julia Boorstin. With Disney CEO Bob Chapek, Tim Seymour, did you get the answers you wanted to hear as a shareholder?
Well, the commitment to content, but the commitment to new markets and the understanding that I think Disney holds the cards. They have the brands and they have this flywheel. So they're also in a position where they're going to move with technology. And as Bob said, we're going to listen to consumers and we're going to see ESPN is still a wildly powerful brand in sports. And it's just linear TV's demise is not necessarily ESPN's. So I think, again, they control the levers here. New markets and content are the keys to the stock, and they've given you a sense that the second half of 22 is going to be very exciting.
Pete, you said you'd be looking to possibly get in at around here. Did he say anything to convince you either way?
Well, I think Bob always is very clear about exactly the direction. You said it, Mel. We talked about that earlier before the earnings about what he had promised about what's going on, and it's exactly right. So I think we do need to listen to him. I think he's doing an outstanding job of listening about just about every different aspect of the business itself. He even obviously touched on the metaverse and everything. So it's a combination of the betting, the sports, and everything else, and the content. I'm pretty impressed with what he had to say. I do think it's still stretched, but I'm getting a little bit more interested. Tim mentioned the second half of 22. that makes me feel like I've got a little bit of time to think about this. It's not something I got to do in the next 24 hours or something like that. So I think I've got some time.